Hello and welcome to Season 6 of NSE Finwiz, powered by CNBC TV 18. I'm Ridu Bhandari. In Season 6, NSE Finwiz continues to spread financial literacy across corporate campuses in India. And today we are in Kolkata, on campus at a PSU that's committed towards providing energy security to India. We are at the Coal India campus in Kolkata, and a set of financial experts is here to engage with the employees and give them some money management mantras.
सरकार के निजी कोयला खदानों को अपने कब्जे में लेने के बाद 1975 में कोल इंडिया लिमिटेड एक संगठित राज्य के स्वामित्व वाला कोल खनन संगठन के रूप में अस्तित्व में आया और तब से कोल इंडिया हमारे देश की प्राथमिक ऊर्जा में एक वैश्विक खिलाड़ी के रूप में उभरा है। NSE Finwiz अपने थीम इन्वेस्ट इन योरसेल्फ योर पाथ टू प्रोस्पेरिटी के साथ कोलकाता में कोल इंडिया के कर्मचारियों के साथ वित्तीय योजनाओं पर उनकी धारणाओं को समझने और उन्हें वित्त की बेहतर योजना बनाने के लिए शिक्षित करने का काम किया।
Financial literacy to me means what amount am I able to save for my future and what amount I am paying to the government.
Wealth management is very important for employees. Like for employees you get a fixed amount of income every month and you have to divide that income for your daily expenses for future. So that amount has to go in a better way.
For people who earn a steady income over a period of time, managing their fund and investing in good investments will yield better results for them in the long run. And that is of paramount importance because everyone needs to be financially secure in their life.
Welcome to Season 6 of NSE Finwiz, powered by CNBC TV 18. We are at Coal India in Kolkata today, and our financial experts are here to engage with the employees and share valuable advice on growing and managing their wealth. Let's welcome the experts on the show today. Uday Dhoot, founder of oepesa.com, and Tarun Birani, founder and director of TBNG Capital Advisors. Welcome, gentlemen. It's a pleasure to have you on the show today. Invest in yourself, your path to prosperity. That is the theme that NSE Finwiz is exploring this season. So Uday, let me begin with you. What are the essentials of investing in yourself and really creating your path to prosperity as far as finances are concerned?
So we talk about 3 E's, so which is basically education, experience, and then sort of finding your own sort of efficient way of managing your money and why it is important. So first of all, what happens is that when we are close to retirement, all of us have been putting away money for very long, for all our working days, towards gratuity, towards PF, etc. And pretty much at the age of 55, 60, 65, whenever you sort of retire, you get a huge chunk of money at one go in your hand. If you have not experienced managing money early on, then it becomes very difficult to handle that large chunk of money because any small mistake there could have a large impact on how you sort of run your things or no. So I think it is very, very critical that you continuously keep doing things with your money, even if it is small money right now, investing, saving, trying different types of asset classes. So educating yourself, experiencing different types of investment so that whenever you need to take that big decision, you are not scared. You already know how these different things work. And the third piece is basically being sort of absolutely efficient about it. And when I say efficient about it, there are 2 things to it. So one is basically being comfortable with your investments. The second is being comfortable with your expenses as well.
So who should be putting money? How much should you put in the market? That's a question that most people have. Would you like to elaborate on that?
Every person has a very different money personality. So it is very important for us to first identify what is our money goals. So some people just want to retire at 50 only. They want to take a voluntary retirement and they want to live in their hometown somewhere. Somebody want to make sure their kids' future they want to spend a lot of money on that. So figure that out. Right. So this is a big question I want you to ask yourself first of all. What is your big goal in your life? Once you have figured out, trust me, all the other things, equity mein dalna hai, real estate mein dalna hai, mutual funds mein dalna hai, all those things are a very secondary discussion. So equity is a very different animal. In last 15 years, I have seen that 1 year equity is negative, 3 years it is positive, 2 years it is negative, 3. So I can't draw a line that how it is going to behave 3 years down the line.
The power of compounding is something that, like you to explain, Uday, with perhaps examples for people who started investing late in life, perhaps if they had started 5 years or 10 years earlier, or people who are still double-minded about putting their money into a regular SIP or any sort of instrument on a monthly basis.
If today you have 10 years to your retirement also, you have at least 15 to 20 years in your retirement, which means that from today you have at least 20 to 30 years of investment horizon when you need the money. We better take risk today where we are in a position of comfort than be forced to take risk at a later point in time at a situation of discomfort. So basically you don't want to be in a situation at age 65 saying that, hey, I don't have enough assets to last. And everyone, frankly, what is this thing about richness or how rich I want to be? Essentially, I want to be independent. I don't want to go and ask my son or daughter or anyone to take care of me. I want to be completely independent on my own. Whether I am ill or otherwise, I should be financially taking care of myself. So I think for all of that, we need to do these things.
Tarun, what should an ideal portfolio look like? How diverse should a portfolio be? What are the essential asset classes that one must have?
The first thing which I told was define your purpose. Define your important goals in the life. And these goals could be driven in three ways, right? There could be a lot of short-term goals, a lot of medium-term goals and a lot of long-term goals. Your short-term goal for everyone, what is the most important thing? Something happens to me, let's say 6 months I am at home, my home expenses need to be taken care of. That's the contingency expenses. So that's the most important goal. Where would you park that money for? I think the fixed deposit or bank account or liquid funds. That's the place you want to park your money there, right? Medium term goals could be anything like your child want to study, after 3 years you have a goal to send him somewhere. For that you are saving money for that. I think that could be a medium term goal. You want to buy a house in 3 to 5 years. For that you have a lot of choices available. Let's say you can look at a hybrid kind of asset class with a mix of debt and equity. Coming to long term, I think that's where the asset classes like real estate and equity comes into play, because these are the assets which have really created long term wealth for us.
Our core topic of discussion today is traditional investment options versus new age investment options. Conventional products usually consisted of fixed deposits, of public provident fund schemes, of post office schemes, etc. Today there are a host of new age investing options, mostly with respect to mutual funds. You have ELSS, you have debt mutual funds. First up, please give us a primer of sorts on how these two are different, and two, how much money should you be putting in percentage terms in traditional versus new age options? Would you like to start, Tarun?
You have different kind of asset classes. Fixed deposits, your EPF and all these asset classes will give you secured return. So you have a lot of surety that this money will come in, right? At the same time, equity as an asset class in 1 year, 2 year, 3 year, there is no guarantee what kind of returns you are going to get. To start with, for a first time investor, we always start with, let's say, a little bit of equity. Slowly you keep increasing as your confidence level in that asset classes increases, right? So there are a lot of factors which goes into identifying what should be the ideal asset allocation for all of you. First important part is what age group you are in, demographic. So if you are a 25-year-old guy versus somebody at 55 who is going to retire at 5 years, I think the equity proportion need to be different for them. What has been your investing experience? Somebody who is starting for the first time, I would definitely give him low equity compared to somebody who is, let's say, investing for last 5-10 years. More importantly, I think what are your important goals? I think to simplify things, 100 minus age should be your equity asset allocation. One can look at.
That's a good formula to follow. We are also in the tax saving season right now, and often this comparison is made between PPF and ELSS. Although PPF is a debt product and ELSS is an equity linked saving scheme, but can you weigh the two for us? Because from a tax perspective, both give this similar benefits, right?
I think 20-25 years back, fixed deposit rates were so high, PPF rates, NSE rates were so high that you didn't have to think about doing equities. But now, a fixed deposit is at 6-7%, 7%, and then you got to pay, depending on your tax bracket, 30% tax on that. So you are essentially saying that, hey, I will get 4.5-5% after tax return if I put money in a fixed deposit. All your regular endowment type insurance policies will earn you nothing more than 6-6.5% by giving them money for over a 20-year period. Now, when I want to save taxes, the beauty of saving taxes is that you basically have all types of options to save taxes and still achieve your financial goals. And let me explain this to you. Let's say I want to save taxes and plan for my retirement. Then if my retirement is 20 years away, I'm already doing PF in my company. I could very easily do these retirement mutual funds or equity linked mutual funds because they will give me higher return. I already have a balance between debt and equity, and I don't need this money for the next 15-20 years. And this is how our whole tax saving structure is designed, right? You want to save taxes and ensure that your hospitalization expenses are taken care of. You could buy a critical illness policy, you could buy a health insurance policy. You want to save taxes and you want to ensure that, hey, can I plan for life cover, then you can buy a term insurance policy. So I think there are almost all options available within the tax saving, wherein you can not just do tax saving but also do your financial plan alongside as such.
Okay, let's take the first question that's come from the Coal India employees. Rishabh Agarwal, management trainee in finance. The question is, are corporate fixed deposits risk-free? Can they be preferred over conventional FDs by a risk-averse investor?
They are corporate deposits. They pay you a higher rate of return as compared to other deposits, whether it's a bank deposit. So obviously, there is a perceived higher risk which is there. I think the important thing is that even if I am doing, say, a corporate FD or a bank FD or anything, I think the most important way to really make yourself safe is to diversify your assets.
Okay, the next one is from DV Sudha from the MM department. How does ETF differ from mutual funds?
Under-researched ideas are very high in India compared to globally in the developed markets. So that's where the ETF are very popular there, because these are like structures created where passive investments are done. There is no fund manager which is required there. So due to that, the cost of ETFs is very low. It is hardly 10 basis point, 5 basis point compared to a 2%. We are witnessing in India also, at least in the large cap category, where the blue chip stocks versus a ETF in last 3 years, 5 years, they continue to deliver better returns. So it makes a lot of, it is making a lot of strong case that ETFs could be looked at compared to large cap funds.
And in this segment, our financial experts will be answering all the questions that the employees here have. So if you have a question, ladies and gentlemen, please raise your hands and wait for the mic to come to you. Yes, sir. Can you please stand up and ask your question?
Can you please elaborate on 100 minus age? What you mean by securities, or can you please elaborate?
For somebody who want to just kickstart and start investing to simplify things, so let's say your age is, let's say, 40 years. So 100 minus 40, 60% is a proportion which can go in equity. Again, this is not a ballpark figure, but at least to start with, one can start looking at hybrid funds, hybrid equity funds to start investing.
Okay. Next question, please.
One of the biggest mistakes that investors make is that they invest when the markets are at all-time high. So since the entire objective of this program is to evince the interest of the investor to invest in the market, so is it the right time for making the investment given the global scenario as well as the macro factors concerning our Indian economy?
I think we should simplify things. And how can we simplify? Figure out your important goals, figure out your asset allocation, and ensure your monthly savings or quarterly saving or yearly savings start channelized for those goals. And keep reviewing your asset allocation over a 6 monthly period as the goals come closer. I think that's the best way, rather than getting into that market talk that what is going to happen in the market next year.
Next question, please. Can we have the mic to the lady here?
My question is that I want to invest around 20 to 25,000 per month in a mutual fund or SIP, but how to select the optimum mutual fund for me? See, I want to invest for the next 15 years maybe.
Today you start 50-50. Okay, put 50% of the money in debt mutual funds, 50% of the money in equity mutual funds. You have 15 years of time horizon. See over the course of next 1 year, 2 year, 3 year, how you as a person behave looking at these investments. How do you react looking at these investments? And then depending on how comfortable you get, you increase equity allocation. Ideally, I would want, if your other things are taken care of, this money should, because you have 15 years, you should go more into equities, but you build your own comfort around it and then slowly start taking your equity exposure.
Next question, please.
So I would like to know something about equity-linked saving scheme. I think that's a hybrid kind of an investment.
Equity-linked saving scheme is not a hybrid-oriented structure. It's a 100% equity structure. It has a 3-year lock-in and it gives you a benefit of ATC in taxation. And you can use this ELSS scheme for your long-term wealth creation purpose.
Gentleman at the back, please.
I have to spend 20 years more. I have got some chunk of money. And I have to beat inflation for maintaining the coming 20 years of life. Right. What are the process or what are the way of investment should be done so that we can beat inflation rightly without too much of risk?
There is no outcome of higher return without taking higher risk. So let's start from the very basic. What is today in our parlance the least risk investments? It is fixed deposit, right? No risk. So it could be a fixed deposit, it could be an NSE, it could be a PPF. These are risk-free investments in our mind. Now, anything that you want to do, say from a bank fixed deposit, you want to move to a corporate fixed deposit, obviously there is a higher degree of risk that you are taking to earn that 1.5–2% higher return. If you move from corporate fixed deposits to say equities or equity mutual fund, then there is another higher level of risk that you are taking. Now coming how you should think about your investments is that when you are saying that, hey, I have now 20 years in my retirement, you have to essentially, let's say, break this into 4 years or 5 years of bracket. So first 4 to 5 years, there is next 4 to 5 years, then another 4 to 5 years, then another 4 to 5 years. Now then say that, hey, I need to ensure what my monthly requirement is, and for the first 2 to 3 years have I taken care of, kept that money safely so that I keep getting those monthly money as and when I need it. The other thing that you obviously need to take care of is health condition. Ensure that there is sufficient health cover. If you already have that through the company, great, but otherwise sometimes the health covers that we have from our companies or from insurance companies do not necessarily cover many other things. So they might cover hospitalization, but let's say I have got a health condition where I need to be at home and somebody needs to take care of me, then where is that situation covered? So you need to then build in that additional surplus for that. Ideally, when you get that large chunk of money, I would say go spend time with an expert who will help you guide those investments. Do not take hasty decisions because you get only one chance to plan your retirement.
All right. Thank you very much, everyone. Thank you, Coal India, for having us on your campus today and for being such a participative audience today. Thank you, gentlemen. With that, it's a wrap of this episode of NSE Finwiz, powered by CNBC TV 18. We'll be back next time with another set of experts from another corporate campus of India, bringing you valuable advice for managing and growing your money better. Thanks for joining us. Goodbye.
Today we were really fortunate that we were able to participate in the NSE Finwiz program, and kudos to the CNBC TV 18 team for bringing this to our company, Coal India Limited.
I was thinking about investing in corporate fixed deposits before this session, but as the experts advise that investing in it won't be really wise. So I'll stick to bank FDs for my safe investment component in my portfolio.
A particularly very informative part which I found was 100 minus age, because we always think what is the right balance to invest. But then 100 minus age gives you a fair idea that where you need to start. And also there is no right or wrong time to start investing. So I think it was a very informative session.